The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Help us, Micron. You're our only hope. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. and let's take a look at this market. You can see we're rallying right now on the S&P 500 higher by 0.7%. Once again, it's big tech that's the story here, the driving force, higher by 1.6% on the NASDAQ. A lot of that is coming from the chip space today, which has been sort of a fickle relationship over the past several weeks, but certainly to the upside today. Take a look at Brent. You're seeing a little bit of that action come out of the market that we've seen with all the geopolitical tensions reigniting. Brent currently down nearly 3%. And a rally in the bond market. 10-year Treasury yields lower by about 4 basis points, Romaine.
Absolutely. You go back to equities and the two-day doldrums that we had seen in the equity market, certainly getting a bit of fresh air on this day, and it's really no surprise as to why. The trillion-dollar AI build-out getting a few more billion-dollar logs thrown onto the fire thanks to Micron, the memory chip maker, which last year said it was going to double its long-term Capex plans to about $200 billion over 10 years. Today, it's now saying it's bumping that to 250 to help meet demand for its memory chips, and off to the races this market went. Now, behind the curtain, this news is certainly going to be a nice shot in the arm for South Korean competitor SK Hynix, which is set to price out its U.S. share listing in just about an hour or so from now. And Micron's increasing commitment to the AI spend is not just lifting chip makers, but giving hope for really everything else. Energy stocks, material stocks, robotics names, even the beaten down software space getting a bid on the day, as our financials, as our transports, as our biotechs.
The thing that I'm recognizing is that everything is becoming an AI trade, right? Whether you're going to reap the productivity benefits of using the tools, whether you're part of the supply chain that allows the thing to come to life. I mean, AI is everywhere. And so it's how you play it, not whether or not you play it. I think that's the big question for investors going forward.
We're going to talk a lot about that today, but don't worry, it's not just all about AI. Consumer stocks are in focus with Costco last night reporting a deceleration in comp sales for June. PepsiCo undershooting expectations on profit margins, saying the consumer in much worse shape than it had anticipated. But at least we're still buying jeans, Katie Greifeld. Levi Strauss, their shares back to near their highest in about 4.5 years. On denim luxury. I don't know what that means, but it's good for Levi.
Denim luxury sort of sounds like an oxymoron, but I digress. Let's talk a little bit more about the everything else in this market, because I love this chart behind me. You're taking a look at the Bloomberg Magnificent 7 price return index. That's in blue here. The white line is the S&P 500 excluding the Magnificent 7. So again, everything else. And you can see it's the everything else that is really outperforming so far this year, higher by nearly 14% or so. You compare that to the Magnificent 7, which is higher on the year, but only to the tune of about 1.1%, Romaine. So it's really interesting here when you think about this divergence that you are seeing. You have the Magnificent 7 basically bankrolling the rest of the AI trade, but not necessarily seeing those gains themselves.
Absolutely. As we kick you off to the close here on this Thursday afternoon, Stephanie Gill joins us here in Studio 2, CIO over at Robinhood Markets. Great to see you again, Stephanie.
Thanks for having me.
Every time we talk about sort of the end or maybe a major disruption in this AI trade, we are sort of reminded very quickly there's still a lot of money fueling that. And I am curious, when you look at client activity, is the conviction that we're seeing today, has that been relatively consistent even when we have these sort of down days or down weeks?
So consistent. Yeah. I mean, obviously you can see sometimes they pick up some other things, but last couple of days where everyone was worried that the AI trade was over and had been overdone, lots of buying in names like Micron, and just the whole area as well, and tons of conviction in buying the dip.
I'm curious about sort of the whole area, if you will. I mean, I know Micron, SanDisk are basically the two biggest gainers, at least among large cap stocks this year. But we have seen a lot of this rotation within tech, the idea of whether you're taking profits from some of the chip makers and maybe trying to find sort of who the AI beneficiaries might be. Are we seeing that in a material way, or is this just chatter?
I think, at least amongst our customer base, I think it's a little more chatter because it has been so focused on like the memory trade and not so much other things. I mean, and I've seen a little bit of like volatility playing in terms of like buying a little Microsoft, then selling it, buying a little Nvidia, and then selling it. But it's been generally like all buy signals in the AI specific names.
And I would love your perspective on what you're seeing when it comes to the Robinhood client base about how they're treating some of these leveraged ETFs. What's going on in South Korean markets is the talk of the town. A lot of concerns about these leveraged products sort of causing this tail wagging the dog effect. What are you seeing in terms of demand and appetite and interest when it comes to these products stateside?
Yeah, we see it, especially in the semi space. I mean, that's where I've seen the biggest take up of levered, positive, not short, but the other side. And that's also been pretty consistent. So I would say that it's been long only mostly, and then there's been some options playing too, which is another way to get leverage. Yeah,
it's interesting. Just, you think about the ratio of leverage long assets to leverage short assets. I think it's at its most dramatic that it's been since these products really took off.
Which will create volatility in the market.
Certainly, and you're starting to see that. You do point out in your notes that you're seeing your customers favoring single stock buying over ETFs since the end of March. And I wonder what signal that sends.
I think that's how they play opportunistic. When the markets sell off, what you see is that's when the ETF buying ticks up, and it's typically in the broad-based indices. It's been pretty consistent every time we've had a dip. That's how they buy, and I just pretending to get in their minds might just be like, I'm not sure, but the markets are down, I'm just going to buy. I don't know which one to buy yet, but then as soon as things start recovering, they start playing individual names.
I am curious about the earnings season coming up. Not so much that it's going to be bad, but almost the idea that everyone expects it to be great and phenomenal. And I do wonder if we're going to sort of head into this wall of sort of the curse of high expectations, that it doesn't matter what you report, that it's going to be a sell the news event unless it's just something really phenomenal.
It worries me because with Broadcom and then Samsung more recently, I feel like that recently set off this recent sell-off, plus the Meta news with the selling of compute. But I was looking at it, and the top 5 names are like the Intel, like things are just up so much, and then you've got energy names that also have huge, much higher expectations by quite a bit. So, yeah, it does worry me, but I think there's probably some that will beat, but I do fear that we're in that place where even if they beat by a lot, there's like one detail that people don't like, and then they.
And I feel like everyone's kind of looking for that kind of canary in the coal mine. Like they're looking for that evidence that somehow we've hit a roadblock or this is all over.
They are, but I still feel like we're kind of early in this. We're going to have speed bumps, but overall, I still feel like we're kind of early.
Well, Steph, I'd also love your perspective on the broadening that we've been talking about over the past few weeks, and you think about that chart that I showed at the top, the fact that the Magnificent Seven hasn't really done all that much year to date. It's really the other names in the index that you're seeing a lot of signs of life. Are you seeing any interest in stories outside of AI, outside of tech, when it comes to the clients that you're working with on Robinhood's platform?
Occasionally, you get like a pop-up in some name that I think a group of people decide they want to try to save that is not related to AI. But I can't say that there's been anything really thematic about it. It really has been very tech focused. I feel like that story is pretty boring, but it is what it is.
Yeah, and how much in terms of the attention economy is traditional stock trading competing with prediction markets, which of course are all the rage right now?
Part of me thinks that prediction markets is competing with crypto more so than kind of the broader stock market. And prediction markets I like to follow I mean, obviously sports is interesting when you have so much stuff going on, but I like to follow the non-sports, and you see a lot of people actually playing the price of Bitcoin prediction market, and that might be in place of like actually playing Bitcoin, and then also like what will be the temperature in LA, and obviously it's been pretty hot.
Yeah, absolutely.
Across the country.
Absolutely, Stephanie. Always great to have you.
Thank you.
Stephanie Guild, CIO over at Robinhood. As we count you down to the closing bells, we are going to focus in on some of those consumer stories today and discuss some of the trends emerging in the retail space, in staples, and of course in discretionary. We're going to catch up with Dana Telsey, and we're also going to catch up a little bit later with Bonnie Herzog on those Pepsi results.
And then we pivot to the other story that's driving markets, and of course it's tech stocks. A broad discussion on how to play the constant AI and chip headlines with Ankur Crawford, Executive Vice President, Portfolio Manager over at Alger.
And part of that conversation is going to involve that IPO pipeline, and we are waiting for another IPO, or another listing, we should say. SK Hynix set to have its U.S. listing here a little bit later. We're going to catch up a little bit later with one of the chief architects behind Google's IPO back in the day, Lise. Stick with us. This is The Close on Bloomberg.
shares of Levi is actually falling a little bit after the company raised its full-year forecast by less than some investors had been expecting in yesterday's afternoon earnings report. Still, it's second quarter in a row boosting those full-year projections. But is the more muted tone a sign of trouble ahead? Let's ask Dana Telsey. She is CEO and Chief Research Officer over at Telsey Advisory Group. Dana, great to have you with us. So, I mean, Romaine and I were just talking about high expectations heading into earnings season. And I wonder if, that's sort of the answer to the reaction that we're seeing in Levi shares today. Because, I mean, you think about the 2026 they've had so far, it's been pretty impressive just in terms of stock performance.
Exactly. It has been impressive, and it continues to be. I think there's conservatism built in their guidance. I think there's opportunity in the remaining 2 quarters of the year that they have left. I think when you think about whether the women's business growing, and it's 40% of the business growing double digits, the men's business, which is their biggest category and the most mature, also showing growth. You look at the fact that they're extending their reach beyond bottoms, but to tops, skirts, shorts, there's a lot of runway there. Look at Beyond Yoga, which also showed double-digit gains, and they're expanding their reach also beyond just activewear into casual wear too. So I think there's some conservatism. They've also seen fewer promotions. They've sold more at full price. Their product costs, they're managing very well. So I think there's opportunity, and let's not forget, they've been very effective at marketing.
Yeah, well, I'm glad you highlighted Beyond Yoga in particular because the growth there is certainly catching attention. And I mean, you think about the athleisure space, we have this conversation all the time that it's very crowded and it's very competitive. And I wonder, how they've managed to differentiate Beyond Yoga to the degree that they're seeing these gains.
E-commerce is the bigger part of the business for them in Beyond Yoga. Remember, they only have 20 stores. I think the fact that for example, now even different fabrics like linen is becoming important for them. So they have expanded their reach in category, in fabric, and they're doing it even more at full price. So with the e-commerce channel, typically the halo effect when stores open, you should be able to get definitely more incremental revenues. I think that's what they're doing. It's not just activewear, it's activewear and casual wear.
I am curious, Dana, this is a little bit more in the moment, but I am curious about the potential bump that Levi and really any brand gets amid a big sporting event like the World Cup. There's obviously been a lot of jokes online being made about how it had to cover its logo on Levi Stadium out west and how they use that as a very creative marketing opportunity. But do you typically see companies that can affiliate themselves in one way or another with these events get a bump in sales?
I think you do. You do see a bump in sales. We've seen it from World Cup and what we're hearing about, both international and here in the U.S. about bumps in sales. But you know what? It's events overall. Look, last year, Levi's had Beyonce, and they created a moment with Beyonce. Beyonce even had a song with Levi's, the name Levi's in it. So what they're doing effectively, whether it's sport, whether it's music, you're seeing a lot of retailers hone in on these moments and market them with product. Look what Gap just did, where they hired a president of fashiontainment from Paramount. So I think the doing and the buying and the wearing are all managed together to create a halo of more dollars from existing customers, capturing new customers. And let's not forget how everyone wants and is looking towards that Gen Z customer too.
Well, okay. Actually, I'm glad you brought that up because we were speaking with someone the other day about the retail space, and she was kind of pointing out the difference between various retailers and how some have clearly gone after the Gen Z customers, but how there are certain cohorts that are actually trying to embrace older customers like myself, the Gen Xers and the older millennials, the idea that, we still buy stuff too, Dana. Do you find there are certain companies out there that maybe see a strategy where they can differentiate themselves by not going after Gen Z and focusing on maybe middle-aged folks?
I think it's not an either or, I think it's an and. And I think that's why you see so many loyalty programs being very effective. You're thinking of customers who have been attached to brands. They're now adding enhancements to their loyalty programs to make them even more loyal. Or you look what some brands are doing. They're adding food. Look what Coach is doing with the Coach coffee shop. Look what Ralph Lauren has with their restaurants. So I think it's an and, it's not an either or. Take a look at Aritzia. You're seeing the grandmother, the mother, and the daughter all shopping, and we're going to hear more from them when they report their numbers today after the close.
Yep, we're looking forward to that. Dana, always a pleasure, always insightful. Dana Telsey, CEO, Chief Research Officer at Telsey Advisory Group. When we come back, we're going to continue our focus in on the consumer sector with Pepsi shares down the most in about a year. This after this morning's earnings report, which, well, offered a lot of insights here about the state of the economy and the state of the consumer. That's coming up next year on The Close, right here on Bloomberg. Time now for our top calls. The big movers on the back of analyst recommendations. We start off with Mattel. Goldman, which had a buy rating on the toy maker in 2025, downgraded it for the second time in 2026, this time to sell. The price target at a street low 12. The analyst citing execution risk and a more volatile backdrop. The share is down a second day and 1 point on an intraday basis at the lowest since 2020. Next up, Salesforce. KeyBank downgrading the software stock to sector weight, removing the 290 price target. The analyst saying difficult to find evidence of future upside, saying that feedback on the company's AI agent hasn't been encouraging, though we should point out the analyst actually admits that it's possible he's downgrading Salesforce at exactly the wrong time, though those shares down for a second straight day as well. And finally, an upgrade. Knight-Swift, Citi upgrading the buy. The firm expecting freight transportation companies to deliver standout quarterly results as trucking capacity has tightened and demand has improved. Those shares up about 4% on the day, and those are some of our top calls. We do want to keep an eye on Pepsi. We mentioned it earlier. The shares down about 3.5% to the worst day that we've seen since July of last year. The earnings report we got this morning was a bit mixed, with a drop in North American sales and the company blaming high gas prices for what it called a worse than anticipated activity amongst its consumers. Joining us right now to talk a little bit more about this is Bonnie Herzog, Managing Director and Senior Consumer Analyst at Goldman Sachs. She's got a buy rating on the stock and a 180 price target. Nice to see you, Bonnie.
Nice to see you.
First, let's talk about expectations coming in. I know the previous quarterly report, we kind of got an inkling that there were some issues, and we know they were trying to find their rhythm in terms of how to price products appropriately in this environment. It seems that was part of the problem with the results that we just got, not just demand, but the idea that maybe they didn't meet that demand where it should have been.
Yeah, it's really been an issue within North America. That really has been slower than we expected. Now, we had some evidence of this as we were monitoring the tracked channel data. So I think a lot of us knew the quarter might be tough and a little bit of a step back, which we saw in terms of results. So organic sales for Pepsi came in a little lighter, 2.4%. We were hoping for an acceleration in Q2 sequentially from Q1. We didn't get that. So I think it's just taking longer for this essential turnaround to take hold. The company, we actually hosted a call with the management team this afternoon. So we had an opportunity to speak with, the CEO and CFO. And I think what's important is that they feel confident about the strategy that they've implemented. They're staying the course. They're making some tweaks. And hopefully we'll see some improvements in the back half.
When we start to talk about the tweaks, I mean, what does that mean? Does it mean cutting prices, offering promotions, changing portion sizes, what?
They've been doing all of that, to be honest. It's all about affordability and the perception of that. So I think they're honing in on some of their value propositions and maybe thinking about it differently by channel. So one area of weakness that they've been experiencing is in the convenience store channel, immediate consumption, single serve. That's a higher margin channel. So right there, in terms of what they've done, it's not giving them the desired effects or impacts. So they are moderating some of what they've been doing there and kind of leaning in more on some of the multi-packs and value in other channels for consumers. So putting that all together, that combined with a lot of the innovation that they put in the marketplace, some improvements on shelf space allocation, we're optimistic that things are going to get better. But I think it's going to take a little time.
Well, pricing is what I wanted to talk about as well, whether they have room to cut costs here, because you think about the move they took earlier in the year, cutting prices by up to 15% when it comes to medium-sized bags. Initially, it did seem like that was leading to a little bit of a rebound. It since has sputtered there. I mean, do you think at this point that pulling that lever again would be an answer?
I'm not convinced of that. I think they are the same conclusion. So I think that's where it's not so much of cutting prices further, but I think it is just kind of refining what they've been doing, whether it's, again, on the pack sizes, channel mix, and what they can do there for the consumer. And the permissibility also. So affordability is one aspect of all of this, but keep in mind, it's really their products and the innovation that they have been putting into the marketplace. And if I've covered PepsiCo for a very long time. And the innovation pipeline this year is one of the most robust pipelines I've seen in a long time. So that hopefully is going to start to resonate more.
Yeah, well, let's talk about that a little bit more, because innovation, I assume you're talking about, those protein products, fiber products, both of which are very hot right now.
I know.
So are you seeing signs that is resonating, that is worth that investment?
Yes, a little bit. You have seen some volume growth. I mean, the good news is in the first half, you've had volume growth in Pepsi Foods, North America. I think ultimately what investors need to see is that continued acceleration. So as they pull back, on the pricing and the affordability, you need to see a little bit more of a lift on volume, ultimately balancing both to drive sustainable top line growth. So that's really what the company's trying to get back to. So it's going to be a combination of them continuing to refine, staying the course, et cetera.
On that point, though, I mean, we've spoken with a lot of the retailers, not just in the food. They've talked about this idea that the stuff that is outperforming in terms of sales are things that are unique to a certain extent. And I noticed something. I don't know exactly where the research came from them, but it was the idea that some of their flavor types of, Cheetos and Doritos and things were doing better than the standard flavor, the new flavors or whatever. And I am curious as to whether you expect them to maybe lean a little bit more into that. I don't want to call it gimmicks, but the idea is that when you put something new that's out there, people are going to try it and they're going to be less conscious about the cost because it's just the experience.
100%. And it's honestly flavors, it's very important. And you've seen all my companies, whatever it is between beverages, food, et cetera, lean more aggressively into flavors. So I expect that to continue. And also keep in mind, we haven't touched on this yet, but sugar-free, it's all about functionality, protein, whatever it is. So they're going to continue to do a lot of that and lean in there.
All right, Bonnie, that's a good place to leave it. Great to get some time with you. That is Bonnie Herzog. She is Managing Director and Senior Consumer Analyst over at Goldman Sachs. Now, coming up, is the AI rally on pause? We'll assess the best bets in the space over the coming months with Ankur Crawford, Executive Vice President and Portfolio Manager over at Alger. This is The Close on Bloomberg.
Every Capex cycle has the point that the Capex overspend starts to happen. We don't believe that we're there now.
Helen Jewell over at BlackRock Fundamental Equities talking about that Capex cycle. And we should point out, of course, her comments actually came before we got that big news earlier today about Micron. And we've got a little bit of breaking news as well, Katie, earlier today with regards to Meta and its AI ambitions.
Absolutely. We heard from Meta CEO Mark Zuckerberg himself really doubling down on exploring an AI cloud business. Of course, that was a Bloomberg scoop. He gave this exclusive interview to Bloomberg saying that the offers that you get for using the compute are so high that it may make sense in some cases to rent out or consider those kinds of deals instead of your own internal uses. Now, Zuckerberg also added that I think this may be the first time, at least that I can remember, that Meta's models are better than all of Google's models. Certainly a big statement there. Joining us live in studio to discuss is Ankur Crawford. She is Executive Vice President and Portfolio Manager over at Alger. Ankur, great to see you.
Good to see you too.
So where to start? I mean, you think about what Meta is doing, the idea that they're exploring their own cloud business, talking up their own models, an interesting chapter when it comes to this overall AI trade that we've been tracking so closely. And just to set the scene, I would love to hear your thoughts on where you think we are in it, because you think about the Magnificent Seven really lagging year to date. We've seen a big breakout when it comes to the chips versus the hyperscalers. It just feels like there's a large number of cross currents at this moment.
Yeah, there are a lot of cross currents, and I think what's most important is that there's a large number of business models that are in the midst of great change. And something that I always ask our team is, what will this company look like in 3 years? And what will it look like in 5 years? And if the answer is I don't know, then it's difficult to invest in an I don't know. And because what multiple do you put on a business model that you don't really know how it's going to change or morph or be impacted by the impact of AI? So, when we talk about, the Mag 7s, for example, they're all entering these cloud businesses, but, that's really competitive. There's 7, 8 of them trying to go after the same market. 4 of them are going after, these models that they're developing on their own. And so what is the margin doesn't mean that the ROI is going to be bad. It just may not be as good as it used to be, right? And I think that's what's happening with the Mag 7s as people contemplate just the differential in ROI of a business that was like an incredible business, right? All of these were digital assets that had incremental margins that were 60, 70, 80% to an infrastructure asset, which has a slightly different profile. Now, the reason that chips and optical have outperformed so much is because in this whole thing, who benefits the most is actually the chip and the chips and the infrastructure, which rightfully so. I think it was, over 2 decades, chips actually didn't get respect.
Yeah.
And so, and they should, because IP barriers there are incredibly high. It's difficult to make.
Well, then what do you make then of the announcement we got today from Micron kind of upping its Capex target, the idea that it really wants to increase its capacity and a footprint? You have the Korean chip makers. There's this big government project over there backed by close to $1 billion worth to build out SK Hynix and Samsung and their capacity over there. Does that then cement those companies long term as basically being the only games in town?
Well, I think in the memory space, it's pretty clear that, when I started in this business 20 some years ago, there were 7, 8 players in the memory space. Some of them were actually like Taiwanese and funded by the Taiwanese government. And now we have 3.
Yeah.
And we have the Chinese players that are, behind the curve on the technology spot, but they can kind of eat up at the lower part of the DRAM market and the NAND market. But does it cement there? They're kind of already cemented. The question is, are they going to add enough capacity to make up for the demand that they see? And I think they're a little reticent to do that, right? Because historically, every time they've added capacity, they've gotten slapped in the face, and their earnings profile goes to 0, if not negative. And once that happens enough times, I think you don't want to add capacity.
But how do you then sort of measure what longer-term demand for this kind of stuff is, whether it's the chips or whether it's the overall compute? I mean, because we're having the same debate about compute and whether we're going to have this excess amount of computing capacity. I mean, how do you sort of determine what potentially could be a realistic demand point?
I think it's tricky in part because we've never seen a market that has grown and grown at exponential speed. And what I would say is that with agents and agentic AI, the amount of compute that is going to be required is almost impossible to fathom. There's one thing that, and this is the stem of the entire AI trade, the fact that we are going to need an incredible amount of compute. And can we use that compute once it's in the ground? And I would argue if each of us was given a baby Einstein to work with us, wouldn't we use that to increase our own productivity? And the argument is, of course you would. And how many tokens, how much thinking does that baby Einstein actually do?
Right.
It's a lot. It's a lot of tokens.
Well, Ankur, I mean, I want to go back to, your sort of starting point question that, when you're evaluating a company, you ask, what is their business model going to look like? What is this business going to look like in 3 to 5 years? And I have to imagine, across a whole swath of industries, the answer is, I don't know. Who knows at this point? To flip it around, though, are there any companies, are there any sectors, any type of company where you can definitively say that, yes, I do have a pretty good idea what this is going to look like 3 to 5 years in the future?
Look, I think there are several sectors that, whether it's the chips, anything that is a tangible asset, has that benefit of not being quote unquote AI'd. You look in the healthcare space, highly likely that AI will enable some of those business models to an extent that they may become more profitable. Drug discovery may take a lot shorter period of time. So there are several industries that are actually going to be benefited by AI, but there are a lot of industries that are on the other side of that.
The other question, though, I do have about this, and I mean, you've always done a good job of kind of talking about what the use cases can be, and we played a clip at the start of this show where it was kind of, David Leibowitz talking about how everything is AI, more or less, and it was kind of this idea that the AI trade is more than just chips, it's more than just data centers and hyperscalers. So when we start to talk about healthcare, when we start to talk about productivity improvements in, banks and other areas here, have we already reached that point, or is that still kind of further off into the future before we start, in a material way, till we start seeing that?
Yeah, I think it's on the come right now. It's definitively not, we've reached that point in time. I mean, I'm going to cite Roman Chernin, who is the COO at Nebius. And just today, he was talking about how enterprises are just starting to adopt AI, like en masse. And so we're the very early stages of the enterprise adoption, and in part because everything is moving so fast. If you developed for yesterday's quote-unquote AI, I mean, maybe you could have developed it today much faster, much better. And so there's a little bit of, if I learned everything yesterday, then I didn't learn how to make agents.
Right.
Now I have to learn agents, then I have to loop them, and I have to, right? So there's all of these, it's almost like an exponential change in the capability as well.
Is the cost benefit there, though? I mean, there's so much anecdotal evidence now how a lot of executives that had started to use some of these models internally are looking at the tokenization costs and being like, okay, what the heck?
Yeah, I think what we are seeing right now and is when you ask your employees or you tell them that they are going to be judged by how many tokens they use, what do you think they're going to do? Right? If someone tells you, go spend as much money as you possibly can and your bonus will be based on it, guess what? They'll spend a lot of money. They won't be that thoughtful about it, which is probably the wrong way to really use tokens. But what they were trying to do really is just get people to use the tool. Because by using the tool and by incorporating it in what you're doing, it definitively increases productivity. Now, I would say that, probably 90% of what I do initially was very poor productivity because I didn't know what I was doing. And over time, my next set of projects have better productivity. And it's a bit of a learning curve that you have to go up.
All right, Ankur, we have to leave it there. Always a great conversation. Ankur Crawford, Executive Vice President, Portfolio Manager over at Alger. We'll be right back. Time now for our stock of the hour. Shares of IBM down for a second day. A lot of talk about AI and a lot of talk about how companies can use AI to actually get rid of some of their reliance on software companies. That includes IBM, that includes Microsoft, and a story on the Bloomberg terminal says Starbucks, the coffee chain, is trying to do just that. Bloomberg TV markets correspondent Nora Melinda joins us now to talk a little bit more about this. What do we know, Nora?
Well, not great news if you're Microsoft or IBM, of course. So we do know that Starbucks is essentially looking in-house to start coming up with some software that could replace IBM and Microsoft in terms of what they use them for. Now, they use them to track maintenance. They also use them for tracking inventory. And it's kind of the market right now just trying to see if they're actually able to pull this off. Now, we know that this is a company that's been struggling for about, 4 years of back-to-back declines. So they are trying to sort of demonstrate some sort of turnaround story. And when we think about that, we also think about cost cutting. And so the company is trying to bring down some of the costs that they're spending on external software vendors. And that's why you're seeing them turning in-house to kind of figure it out on their own.
And this feels like a real world example of, some of the existential fears that rocked software stocks, on and off throughout this entire year. The idea that AI was going to sort of displace their businesses. And again, this just feels like an example of that.
Right. And I mean, it just kind of begs the broader question. Does AI actually mean more demand for software companies, or is it essentially making it easier for customers to actually replace their software vendors? And that's what you're seeing the market grappling with right now as they try to price in which companies could potentially be affected by some of these shifts.
I am curious, though, about this. And, so when you go into Starbucks now, they have these, like, refreshers now. And I don't know, are they dirty sodas or are they refreshers? That's something different.
I haven't tried one. I just got a cold brew.
Yeah, I don't do coffee, but I like the refreshers.
I like a Frappuccino.
Every time you say that, it shocks me.
But does AI help with that at all?
See, I mean, that's the thing too.
And where is that cold foam that they put on top? What does that actually mean?
The cold foam is the best. I don't know what's in it, but it's quite tasty. I do know that sometimes, have you ever been to a Starbucks and the barista's chatting with you and then they kind of put in your info?
You
don't talk to them?
No, I don't.
Wow.
Every
I say,
time
don't even look me in the eye.
Where's the world going?
It's rush hour. It's like it's a coffee factory.
Sorry, you guys do this mobile orders just so you don't have to talk to anybody.
To the likes of me.
Well, hopefully this should make it so that baristas can actually engage with the customers more if we've got some tech helping out on the other end.
I would like that for all of us. Nora, great reporting as always. That is Bloomberg
Thank you for
TV
engaging with us,
Markets
Nora.
correspondent Nora Melinda. Coming up, it's the closing bells. We're going to take you there with Kevin Gordon, head of macro research and strategy over at Schwab. This is The Close.
Occasionally you get like a pop-up in some name that I think a group of people decide they want to try to save that is not related to AI. But I can't say that there's been anything really thematic about it. It really has been very tech focused. I feel like that story is pretty boring, but it is what it is.
That was Stephanie Guild over at Robinhood, kicking us off to the close just about 50 minutes ago. Green across the screen here in U.S. equity markets, and led by what else? Basically, most of the big chip names.
Yeah, absolutely. And you can see that reflected here. The S&P 500 higher by nearly 0.8%, and it's the chip names, as measured by the Philadelphia Semiconductor Index, higher by 3% today. But I feel like, again, it's been a really fickle relationship over the past few weeks. Some days it's the chip names dragging down the market today, and maybe yesterday as well, certainly providing a catalyst to the upside.
I also think it's interesting to kind of see what's being left out. So Nvidia's in the red, you have Alphabet's in the red, and so you have kind of like some of these, I guess, quote unquote, blue chip names that you would think would be participating in the rally, if not leading it, and yet, you know,
the
here
lag
we are.
7 is a joke.
The
I heard
lag
today.
7. You should patent that.
It isn't mine. I did steal it, but.
Okay, well, you know, some of the best ideas are stolen. Joining us right now here in Studio 2 to count us down to those final moments of the closing bell, Kevin Gordon, head of macro research and strategy at the Schwab Center for Financial Research. And Kevin, I actually do want to start there too with kind of this, not just the rotation trade, but the idea of a rotation in leadership. We've talked a lot about whether we should just even stop talking about the Mag 7 because as a moniker, it's kind of lost its punch to a certain extent. You know, you have Micron and SanDisk, obviously the two outstanding in terms of percentage gainers amongst large caps. SK Hynix is going to be a U.S. traded stock in a matter of hours, and I presume that's also going to be at the top of the leaderboard as well. Where do you look to if we start to collect sort of a basket of stocks that represent sort of the leadership of this market? What does that look like?
Yeah, I mean, I think that at least in this cycle and phase of the cycle for everything AI, you know, historically, meaning the past few years, everybody sort of grouped it in that Mag 7 group, but not only because of them all living in these different sort of categories, whether it's memory or whether it's hyperscalers or whether it's semiconductors, just the dispersion in performance in that group amongst that membership. It's not just a year-to-date phenomenon. It actually dates back to last year, even the end of 2024. I mean, you look at some of the differences in performance and contribution to the index for the S&P, and you've got, you know, Microsoft all the way at the bottom, and then you've got Apple doing well, you know, more recently. That's creating sort of this huge gap between all of these names. So I think that even just from a performance standpoint, it's harder to group them together, much like the stats you guys were just pointing out. You can't necessarily think of them as this one cohort, and we've been trying to tell investors, you know, because of that, there is other ways to sort of group this, and I think the sort of memory hyperscaler semiconductor way or grouping is a way to think about that and think through it.
I understand the concentration that we're seeing now among some of these names, and why not? I mean, if you're looking for a gain, and certainly on a short-term basis, why not? But we had started to see a little bit more broadening out of the trade, and I know that kind of hit a little bit of a road bump over the last couple of weeks. But do you maybe, particularly with earnings season coming up, seeing more investors, more traders starting to look much more far afield than this leadership?
Yeah, and I think, you know, they already have. You can kind of dissect this a couple of ways. So a lot of people don't realize this, but not even year to date or over the past year, but over the past 2 years, the Russell 2000 is outperforming the S&P 500. So you go down the cap spectrum, and that's actually, I think, where the bigger, broader story of the broadening out has been. Even year to date, Russell 2000 value is the best performing index if you you were looking at it versus the NASDAQ or versus the S&P. So leaving that aside, I think one of the interesting things that has happened and why this market has become sort of so rotational, over the past several months, you can sort of use the past 2 weeks, I think, as an example. Absent yesterday, or excluding yesterday, you had 11 straight days where the index, the S&P 500, was doing one thing, but then underlying breadth was the complete opposite. So on up days for the index, net advanced decline was negative, and then vice versa. That sort of kept the cap-weighted index basically unchanged over that period, but even over the past couple of months, all the while you've had all of this churn and all this rotation under the surface. So it's one of the reasons we, at times have called it a duck market, where on the surface it sort of looks steady, there's not much going on, everything looks relatively calm, but then under the surface there's a ton of action. And that's not the first time we've seen it. 2025, there was a considerable period of time where you did see that, but that's kind of the environment we get back into. And I think it's important because from the average investor's perspective, who is looking at the cap-weighted S&P 500, which is the index that gets shown, you may not see as an exciting of a gain over the past several months, but the reality is under the surface, things actually can look a lot better.
Yeah, and I feel like there's lessons we can all take from those ducks. Cool on the outside, but just churning under the surface. I do want to talk a little bit more about small caps, because I do love that stat that you think about the Russell 2000. It has been an outperformer over a number of different time metrics, but similar to the conversation we were having with Steph Guild over at Robinhood at the top of the show, it feels like it's really hard to get investors to care about anything other than AI. I mean, you take a look at IWM, which is an ETF, one of the big ETFs that tracks the Russell 2000. It's actually seen year-to-date outflows of nearly $5 billion. Yeah. So it's not necessarily a story where flows are following performance. And I wonder, if you run into that sort of resistance when you're having these conversations about anything other than tech.
Yes, I do run into it's not as much actually a resistance. I think it's just sort of a hesitancy to step out of tech and sort of look at other areas of the market. So it's not as if clients think that small caps, at least the ones that I have spoken with, just think they're bad outright. But I think also there's a scarring effect at play, because you look at since the start of the bull market in October of 2022, it was by far the worst start ever for small caps, and it was actually the worst start in history in terms of they were down in the first year of the S&P 500's bull market. Has never happened before. So a lot of that scarring, I think, from the lack of participation since the early days of this, and the fact that it's taken so long for them to start participating again, and now that you reintroduce the prospect of the Fed maybe remaining relatively aggressive, even if they don't hike, staying on hold, you start to kind of lose the effect of the rate cuts over the past couple of years for smaller companies. So I think all of that is still sort of building up to kind of a hesitancy around getting into that asset class. But you talk about from a sentiment perspective, the fact that flow activity is still so weak, that's still somewhat actually supportive of the asset class, because you haven't seen all of this euphoria and all of this optimism seep into it. Very much the opposite case for large cap tech, if you want to use that as the other opposite example.
All right, Kevin, always great stuff. Kevin Gordon there, head of macro research and strategy at the Schwab Center for Financial Research. And Katie, I was just looking at the terminal here. You talk about an S&P 500 up 10% on the year, NASDAQ 100 up about 18% on the year, the Russell up 21%, the Russell 1000 value up 17%, emerging markets up 19%. Yeah. So he gets to a good point here, this idea that there has been sort of this stealth breath, if you will, to this market.
And particularly for the Russell 2000, you think about the fact that you haven't seen inflows, you've seen outflows. It's one of the few places of this market that you could argue isn't crowded at this point. So we'll have to see.
Absolutely. And we look here on this day, of course, to the upside, it is your Metas and Microns and Broadcoms leading the charge. We're going to break down all of today's market action with our global simulcast. This starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld taking you through to that closing bell. It's a global simulcast. Carol Master joins us in the radio booth. Lisa Mateo in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. A big turnaround here on this Thursday for all of the major U.S. equity markets, Carol.
Yeah, look at it. We're hovering near our highs of the session. Another little uptick in the last few minutes of trading. But there is, predominantly it's a tech trade. It's an AI-related trade. It's not necessarily your usual suspects. And then once again, you've got semiconductors. Investors just in love with them, up more than 3% in today's session.
Yeah, we're looking at the markets.
What?
I see.
What did you say? It's a love affair.
It's a love affair.
What's not to love about chips? I love cons of chips.
And all the love going on, despite all the geopolitical news we've been covering too. I mean, we look at the Dow up about 0.2%. So yeah, we're seeing green across the screen. Oil actually down about 2.5%.
Yeah, and you can see that love also extending to the small caps. The Russell 2000 higher by about 1.3%. It probably helps that you do see a little bit of relief when it comes to the bond market. Yields down today, but I mean, you think about where we are in terms of the outright levels of yields near the highs of the year, but not making too much of a dent in the stock market today.
Hey, Lisa, have you ever been to Aritzia?
Aritzia, that's my favorite store. Hello.
Okay.
Is it really?
I did not know that.
I go there with my daughter all the time.
Well, guess what? They're going to report earnings after the bell. That's our little straggler here in the earnings season. As we get closer to these closing bells, we are going to see green across the screen for all of the major U.S. indices here on this Thursday afternoon. The Dow Jones Industrial Average, that's basically your laggard on the day. It's only up a mere 130 points, or about 0.25% on the day. The S&P 500 adds roughly 60 points, or 0.8%. The NASDAQ Composite up 1.3%. The NASDAQ 100 up 1.6%. S&P Midcaps up 1.2%. Dow Transports up an even 2%. And the Russell 2000 Carol Master up 36 points, or 1.2%.
All right, good stuff, Romaine. Let's go back to the S&P 500. More than 300 names. Katie, higher in the Thursday trade. 202 to the downside, none unchanged.
Well, let's take a look at the sector level as well. More gainers than losers. 7 sectors finishing in the green. Information technology, that is the bright green slice on the circle in front of you, higher by about 1.7%. Consumer discretionary, financials also having a pretty good Thursday. In terms of what didn't perform, consumer staples down about 1.8%. Interesting results from Pepsi earlier in the day. Energy also off by about 1.6%, Carol.
All right, so a lot of green on the screen in terms of gainers here. Let's go to the number one gainer in the S&P 500 and NASDAQ 100. We're talking about Lumentum Holdings, ticker is LITE. That stock up 11% in today's session. It's an optical networking stock. It's more than doubled this year, up about 118% year to date. Rallying again, I should point out 12% of the float is short. But it plays into that AI trade that was definitely in full force today. And I kind of feel like it plays into the Meta news, which I want to go over to because that stock was higher in today's session as well. You know, you're building AI data centers, and increasingly you've seen a shift from copper to optical networking, photonics, if you will, or the interconnects within the AI data center. So Meta talking about the possibility of it increasingly leaning into data centers. And so I want to go over to that. So you just saw, again, the AI trade. Anybody connected, any of the components that go into data centers definitely outperforming. Meta was up almost 5% in today's session. It is down on the year. Kurt Wagner of Bloomberg sitting down with Mark Zuckerberg, and Meta saying it needs all the computing power it can get. That's according to the CEO. He's also considering renting out some of Meta's AI infrastructure to outsiders. It's also developing plans for its own cloud business. And so that could include selling access to various AI models hosted on Meta's existing AI infrastructure, or also selling access to raw computing capacity. So there's a lot of interesting stuff going on. Meta also unveiled a version of its AI model, Muse Spark 1.1. There's just a lot there. Great reporting by Kurt, but you did see Meta certainly outperforming. And then I got to mention, semiconductors rallying again today. Micron, in particular, that one was outperforming, up 4.5%. Company planning to increase its spending on new plants in the U.S. by $50 billion to $250 billion to help meet demand for its memory chips. So that's a look at some of the gainers, and you've got some earnings, Romaine.
Yeah, just real quickly, let's take a look at Aritzia. This is, of course, the Canadian apparel company out with earnings. EPS just beat at about 96 Canadian cents a share. The street was looking for 85 cents. Revenue a beat at $951 million versus estimates of $923. Margin expansion in the most recent quarter, and the company says that for the full year, it is expecting net revenue in a range of 4.6 billion Canadian dollars to 4.75 billion. The low end of that range is basically right on the nose of the average of analysts.
And in U.S. dollars, Romaine, that is what?
Well, about the same.
I'm being very romaine here. I'm being very romaine.
You're not allowed to do that. Did you notice my lapel pin today, Carol Massey?
I know. That's very nice. Where'd you get it?
You gave it to me.
I know.
You guys.
You do something nice for me every now and then.
I do every once in a while.
Every now.
If I do it often, you're not going to like it as much. You know?
Sure thing.
Just going to say, all right, Lisa, take it away.
All right, on that Aritzia news, because I'm a big fan of them, let's go to some of the decliners. So we'll start with PepsiCo right now. So it was down about 3%. Consumers, basically, they pulled back in the second quarter. Gas prices rose. So that was kind of taking away from their spending. But it's not just PepsiCo, right? They're the maker of Doritos, they're the maker of Lay's, they're the maker of Gatorade on top of it. So they did see a 2% decline. That was in revenue, North American food business, some flat volume on top of it. The salty snacks. So they did see some signs of an additional initial rebound earlier this year, but the problem was it just wasn't enough. So even though they cut the prices earlier this year by as much as 15% in some brands, its CEO put it right out there and just said the consumer is worse than what we had anticipated, and it's driven mainly by gas prices. So that's it in a nutshell. I want to take you over to AstraZeneca right now. Those shares lower as well. It's that and also Ionis Pharma. So they basically, their gene silencer drug, it failed to help prevent heart problems in some patients. So AstraZeneca ADRs, they're down about 5%. We look at Ionis, they're down about 23% on top of that. So basically what the company is saying, they didn't reduce cardiovascular events or deaths from heart problems in a late stage trial. So that was the issue. A successful trial, what that would have done, well, it would have led to billions of dollars in more sales. That's what Jefferies analysts were saying. Astra had this ambition of more than $5 billion in sales of the drug. So we'll see what happens next. I want to end off with Costco. Tom Keene would be in his glory.
Oh my God, you love that store.
He does. Rising gas prices lifts the same store sales, but it was lower than March and April. So that's the issue there. So that's why their shares were down as much as 4%. And that's the issue. So June comparable sales missed Wall Street expectations. The stock may have also been feeling some pressure from Pepsi's. We just talked about that. Their numbers a little bit earlier, but management there, they warned about the consumer. So we see it moving along.
A quick check on yields after a couple of days where we saw them rise, falling across the curve here on this day, down about 5 basis points on the 2-year yield. On your 30-year yield, the longer end of the curve, we're only down about 2. So the volatility we see in the equity market, we continue to see that as well, at least from a day-to-day basis in the Treasury space.
All right, let's go to some stories on our radar. The number of young Americans living with their parents is at a record high. Here's a number for you guys. Nearly a fifth of 25 to 34-year-olds live with their parents or grandparents. That is a record high per a recent analysis of census data by John Burns Research and Consulting. We know it's tough out there. We've done the stories, like graduates coming out, younger folks having a hard time finding jobs.
Well, I have a 24-year-old, so I know it's tough for him.
Living at home?
Living at home, and I think he's going to be at home for a while, depending on how things are going on. Mama's okay with it, but that's all right.
Yeah, I mean, you think about all the different forces in the housing market, structural supply issues there, and then you have mortgage rates pretty high, and it seems like they're not coming down anytime soon. And at the same time, because of that shortage, I mean, prices are super high as well. It's rough out there.
Yeah, and we talk about some of these demographic shifts that are going on out there. And another one, and it actually brings us to another story that we were keeping an eye on the TV side, and that involved CoverGirl. And the idea that, a few years ago, it seemed like everybody was going after the younger consumer, the Gen Z customers, if you will. But CoverGirl has actually had a nice little rebound by actually going after middle-aged women, saying that basically, women in their 40s, 50s, and 60s just offered a better value proposition, but also a way for them to differentiate yourself. If, everybody's running in one direction, sometimes it pays to maybe veer off into you're not in your head there, Carol.
Are you looking at me? Are you looking at me?
What are you looking at me?
I mean,
Give me that back.
I do see it, though. I do see it.
Yeah.
Like on my feed is just a lot of about middle-aged kind of makeup, and that's kind of the hot thing.
And you also know a lot more about those consumers. I mean, you think about brands really trying to capture the attention of Gen Z, of Gen Alpha, and then I don't even know what comes after that. I mean, you have a lot more data on what, Gen X.
Beta, Katie.
Beta? Yeah. Ooh, that's a terrible name.
Zoomers?
Anyway, there's a lot more that is known about Gen X, so it makes sense.
But in all seriousness, too, and we've been talking a lot here on this network about what's been going on in the retail space and some of the rebounds we've seen in companies like Levi and Abercrombie, et cetera, Gap, and the different strategies they're taking in terms of, with demographic, where they see the most hope and the most long-term value. And there is some variance. It's not all just everyone going after the younger consumer.
Yeah, I think especially in the cosmetic space, it is super crowded and super competitive, and there's new entrants all the time. All right, good stuff. Looking good. All right, don't look at me like that, Romaine. I'm just telling you.
I can't hear you, Carol.
Okay.
We've actually gone to commercial.
All right, guys, that is a wrap. Thank God Katie's there. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it The Closing Bell. Katie and Romaine continuing there, of course, on The Close on Bloomberg TV. Lisa and I back here on Bloomberg Business Week Daily on Bloomberg Ready. See you again. Same time, same place tomorrow.
And our coverage continues here on The Close. We are awaiting some news, trying to get some information on the pricing of SK Hynix listing its shares here in the United States. We're going to take a deeper dive into what's been going on in equity markets, particularly the IPO market, and how to handle these massive AI companies entering the public space. Liz Beyer going to be joining us in just a second, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. A pretty significant sentiment shift on Wall Street today versus what we had a couple of days ago here. The S&P 500 up 0.8% on the day, pushed higher by a lot of those chip names. You see that reflected in the NASDAQ 100. It added about 1.6% on the day. The Russell 2000 small caps, we were just talking about this, holding their own versus the broader market, maybe aided by this drop that we saw today in Brent crude oil.
Absolutely. Well, let's get to some of the individual action at the equity level. I did want to highlight PepsiCo. We've been talking about it a lot today, but really interesting to hear from the company. You saw the reaction from the market, sending shares lower by more than 3%. Pepsi saying that consumers struggling with higher gas prices, and you certainly saw that in their results. But I also want to talk, of course, about chips. You can see that Micron shares rebounding today, higher by 4.5%. Memory certainly top of mind right now, but it wasn't all chip makers of every stripe, because you did have NVIDIA shares fall slightly here, down by about 0.7%. And that brings us to our top story this hour, a resurgence in chip makers overall, powering a rebound on Wall Street as U.S. investors eye a Seoul-based giant. SK Hynix expected to debut ADRs on the NASDAQ tomorrow, with the U.S. listing said to be more than 7 times oversubscribed as we await that pricing for that memory chip maker.
Absolutely. Let's bring in Lise Beyer, founder of Class 5 Group and one of the chief architects behind Google's IPO back in the day. And Liz, I do kind of want to start with this idea of exactly, what we're bringing to market here. I know not a traditional IPO, but the idea of, bringing a behemoth company like this to the market. Is there a reason why they would want to list here, have a listing here, rather than just keep everything over there in Seoul?
Oh, I would think there's a massive pool of potential investors over here. And when you're raising money, it's nice to dive into a bigger pool than a smaller one. So I suspect just the volume of shares that trade over here and the, again, size of the potential investor pool will make the difference. I'm
curious, too, about the pricing. I mean, Bloomberg reported exactly kind of where the pricing might land, about 3% over the closing price from a couple of days ago. But we talk about 10 ADRs to one common share, a reference price pegged to that last sold close, and this idea that price discovery was, I guess, relatively narrow. I mean, I guess, you already had a barometer from what you saw publicly traded over there in Korea. Does that make a listing like this easier when you already have some sort of reference, a major reference like that to go off of?
I think it does, right? A stock that's been trading for a while somewhere does, in fact, have, I guess, a vote of confidence that investors have been willing to pay what they've been willing to pay there. So, yeah, having some basis other than a group of bankers say what the price range ought to be is probably does lend some confidence.
It's interesting. You think about the volatility that we're seeing in SK Hynix shares in its local market. Another way where it's different from a traditional IPO, where you don't get a sense of how the shares are trading or would be trading if they were public. We have the pricing in front of us, and I wonder, in your view, how that affects the potential pricing that we're waiting for right now.
I'm not sure I totally understand your question. You've got the range of where the stock was, and so you're wondering how that affects where it will be,
yes.
I think is what you're asking. again, it serves as an important guidepost. Obviously, a stock that is a listing that is multiple times oversubscribed may in fact jump when simple economics 101, demand is obviously exceeding supply. But I think on this one, I'm going to back off and not comment with any specificity because we're so close to seeing what the market has decided.
Yeah, really just referring to the fact that you think about the stock down 17% this month alone, down 9% just from July 3rd. Certainly a bit of a wild card when you think about, what we're waiting for here. But I want to broaden out and talk a little bit about the demand that we're seeing overall when it comes to new issues. You think about the supply of shares coming in to the market. We haven't seen equity supply like this in a long time, it feels like, Lise. And, I wonder what signal that sends other than, this is a great time to go public. If you were thinking about making a move like this, potentially looking at ADRs or some type of situation like that. I mean, it seems like the stars are aligning for that potential set.
After 3 years of a real IPO drought, it's very nice to see some activity in the IPO markets again. I think investors, for a while, were just playing it safe with the Magnificent Seven. They haven't been doing so well of late. And there's also obviously the whole change in the technology world with the massive infrastructure changes necessary for AI to do what we all believe it will. There's an opportunity for new companies to reach out. I think investors are looking for new issues and ways to differentiate themselves from all the other investors who own the same set of stocks. It's probably also important to remember that just because something does well doesn't mean others can turn on a dime. The preparation for an IPO is 6 to 9 months. So I think we're looking more at futures of IPO markets than, say, August of 2026.
I am curious, though, about kind of where we are kind of in this overall sort of, let's just say, AI cycle with regard, and I'm talking specifically from the lens of public markets. If we had you on a few weeks ago when the SpaceX came to market, the largest IPO that we've had, SK Hynix, the biggest foreign listing that we've had, and we're still looking potentially to digest, names like Anthropic and OpenAI, which will also potentially be behemoths if they do come down this year. Does that signal that maybe we've kind of reached a peak here when you start getting the size that this is it, these are kind of the last giants to come out the gate, or are we reading too much into that?
Oh gosh, I don't think we can say that these are the last giants. There are a number of companies that have been around for a long time and done incredibly well, haven't chosen to go public. They aren't the sexy names, Anthropic and OpenAI, but they may come to market one of these days. But I think what we're seeing now in the IPO market is very similar to what we saw when the internet boom first happened, as strange as that may sound. The scale is different. You got to build out the infrastructure before you can build out the companies that ride on top of it. And so that, I think, is what you're seeing in the semiconductor market at the moment. Obviously, those are all IPOs, but I think that's what you're seeing in infrastructure. Yeah. And I think we'll see it going forward.
Well, actually, I want to draw on that, too, because, I mean, you go early in your career when you're at Credit Suisse, First Boston, and as an analyst, and that was during the dot-com run-up, the dot-com boom, and then ultimately the bust. There's been a lot of talk about this idea that, having SK Hynix come in is good because, at least here in the U.S., you had basically two memory chip makers to choose from, more or less. It was SanDisk and Micron, and maybe to a lesser extent, Western Digital. Similar story for the high-end chips. It was NVIDIA, and what else? That was it. And now you are starting to see an ecosystem, at least in public markets, where there is a little bit more choice about where you can go if you do truly believe in the long-term promise of this AI revolution. Did we have that kind of choice? 26, 5 years ago, when we were getting to the tail end of the dot-com boom?
The tail end, no, but early on, yes. Right. I think when there's great success in infrastructure, you see a bunch of wireless companies. You saw some data center companies. There were a number of connectivity companies that were thriving early in the day. And again, I think that's what we're seeing at the moment. And the other thing, it's a cliche, but it's important to remember that we always overestimate the impact of new technologies in 2 years and underestimate what will happen in 10. And if you look at what happened in the internet era, boy, those stocks went crazy and went up. And then there was kind of an ugly period in the middle. And now, can you imagine a world without the internet? I think we're probably seeing the same, as they say, history repeating, just at a different scale.
I shudder to think of a world without the internet. So certainly take your point there. I do want to talk a little bit more about the IPO market because, you think about the big three that we've been watching. SpaceX out the door. Looks like we're going to get Anthropic in a few months. And OpenAI, reporting that could be delayed into 2027. And I wonder what you make of that, Lise, because, we were talking about how, you think about all of this net supply of equity coming through. It's been eagerly accepted by investors, it looks like. But the idea that OpenAI might delay, it seems like market conditions, one of the stated reasons for why they're reportedly thinking about doing that. Could that have a chilling effect if we do see them sort of hold back? Or, would you say that's maybe more specific to them and their situation?
Yeah, I think investors have a real appetite right now for new issues that can tell a compelling story and that are priced reasonably. And the second part is super important. So yes, everyone's waiting for Anthropic and OpenAI, but I don't actually think it makes any difference if OpenAI says, you know what, we're not ready to go yet. There are so many other big names out there that haven't gone that may choose to. So it's one name, and it's one that gets a lot of attention. But I think, well, look, we just saw last week, we saw Lime go public. We saw Bending Spoons go public. There are other names out there. So if the big guys wait, I bet we'll see some other folks fill that vacuum.
Yeah, fair point there. Let's talk about the biggest guy of all, though, and that, of course, is SpaceX. It's officially in the NASDAQ 100. It's in a host of other indexes as well. And it's interesting because you have this burst of one-time demand from these index inclusions, right? But we're going to see the lockup expirations start. I believe they kick off this month. And, I wonder what you're going to be watching there as we do start to see maybe some of these early buyers actually be able to sell.
I guess what I'll be watching is what everyone else is watching, which is the tape. But it would be reasonable to assume that some folks who've been holding the stock for a while and have enormous gains might want to take some of that off the table. And the lockups do begin, assuming the stock is up more than 30%, I believe is the number from the IPO price, but so far so good. But yes, just again, supply and demand suggests that we're about to see significant more supply, again, when the lockup breaks. So it'll be interesting to watch, but again, I would expect significant supply to hit the market.
Yeah, absolutely. It feels like SpaceX is a really interesting petri dish for a lot of these trends to be playing out in. Lise, great to get some time with you. That is Lise Buyer. She is founder at Class 5 Group. And be sure to tune in tomorrow morning for an interview with SK Group's chair. That's happening at 10:30 a.m. Eastern right here on Bloomberg. But coming up on The Close, this year's IPO buzz putting a heightened focus on private markets and how investors can participate responsibly. Former E-Trade CEO Mitch Caplan, he's now the CEO of Willow Wealth. He joins us live with more next. This is The Close on Bloomberg. Welcome back to The Close. Keeping an eye on chip names, of course, because that's what we do these days.
Yeah.
I mean, chips driving the market day to day, and that includes to the upside and the downside. Today, to the upside.
Yeah, and we should point out, we are waiting to kind of get the firm details on SK Hynix's listing. It will start trading tomorrow. There's been a lot of talk about the recommitment Micron has made to try to build out its memory capacity here in the U.S. We know Samsung and SK Hynix are doing that over in Korea. Howard Lutnick, the Commerce Secretary in the U.S., actually wants Samsung and SK Hynix to do that here in the U.S. as well. But these are the stars of the show. Right? The two best performing stocks in the U.S. right now are Micron and SanDisk. You throw in ARM, which is up there on your screen. These are the prices for today in Lam Research, and ARM has tripled on the year. Lam Research has doubled. This is basically not just our market, but to a certain extent our economy right now.
Yeah, absolutely. And it's going to be really interesting to add SK Hynix to the mix. We were just talking about access for the U.S. investor with Lise Buyer. And I think it's really interesting because you do have this one ETF out there that offers access for U.S. investors to the likes of SK Hynix.
Yeah.
It's at $23 billion already in assets. It's only launched in April, which, in addition to the oversubscription numbers that you're seeing for this ADR listing, also tells you U.S. investors definitely want a piece of this action.
Absolutely, and that has become it. But now, we should also point out, I thought it was interesting, we heard from John Williams at the Fed. He's actually concerned about some of the inflationary pressures from all this AI build out, at least for right now, sort of subsiding. Oil prices down on the day. He's had a drop in yields, but again, it's kind of how this all balances out longer term. All right, when we come back after the break, we're going to catch up with Mitch Caplan, the CEO over at Willow Wealth, of course, the former E-Trade CEO as well. We're going to talk about how he's paving the path for some of the retail investors into alternative assets, right here on Bloomberg. All right, we've talked a lot about on this show here, retail investors tapping into private markets, wooed by the prospects, some of those pre-IPO value creation and diversified gains as well. Our next guest says the key to unlocking the next phase of private markets is helping individuals invest in the space responsibly. Speaking from his helm at the income-focused alt investment platform Willow Wealth, he joins us here in Studio 2. Mitch Caplan, also, of course, the former CEO over at E-Trade. Good to see you, Mitch, again.
Good to see you. Good to be back.
I do want to talk about, we were kind of talking about this, of course, with the SpaceX IPO and all these other gigantic IPOs that are coming to market, and the idea that these are relatively mature companies.
Yep.
And the idea of like whether all of the real gains, or, you know, not forever, but certainly some of the bigger gains have already sort of been made in the private space. And that, of course, has a lot of folks kind of wondering, okay, am I missing out on something? I know you run a platform to help people get into that private space, but does it matter? SpaceX is SpaceX. Either you believe in its long-term story or not. Has value been lost by the fact that so much of that value was created in the private space?
I think it's different, right?
Yeah.
I mean, I think ultimately from the days of E-Trade, you saw companies going public much earlier, right? There was a real focus on trying to be able to access the public markets on the thesis that, you know, was a cheaper form of capital. I think a lot of that has gone by the wayside. And many companies are choosing to remain private indefinitely, or certainly much more mature, which is exactly what you're describing. And so a lot of the wealth creation occurs even during that private phase. But ultimately, I think you're right. SpaceX and others, it doesn't matter, Anthropic, any of them, OpenAI. I think at the end of the day, if you have a solid business model and you continue to execute, my experience in running a public company was the stock eventually takes care of itself.
Well, I'm curious too about that thing. In the private space, certainly in the older day, I'm sure it's changed a lot, but the idea was that most of the investors in those spaces were investing at the earlier stages. And thus you were taking on bigger risk, but if you hit big, you really hit big. As you see more individual investors come into this space here, what is kind of the breakdown of what they're looking at? Are they looking at the mature private companies, or are they looking more towards companies that are a little bit younger?
You know, I think honestly, our job at least is to try to give choice, right? And so the idea would simply be you can look at a more mature company, so somebody who's pre-IPO, to your point, they could be quite large, and therefore they've had a run-up in value already through a series of Series A, B, C, D, E, F, whatever it may be. And then our job is also to find really interesting opportunities in private markets that may stay private indefinitely, right? So it could be in private credit, it could be in private real estate, it could be any host of asset classes that ultimately, I think the real goal is to try to help an investor, very much like we did at E-Trade in the public markets. Here it's in the private markets. How do you build a truly diversified portfolio?
Let's talk about choice when it comes to, you know, means of access to private shares, because especially in the run-up to SpaceX's IPO, you saw this proliferation, this real uptick in interest when it came to SPVs, special purpose vehicles. But I mean, you think about SPVs, there's a lot of legitimate questions there about layered fees, about how much exposure they actually have. So how are you navigating some of that? Because it does get very murky.
Yeah, I agree completely. I mean, I think really the fundamental issue is that access to those, listen, all the way back to the days when I was running E-Trade, access to many of those stocks is really been reserved for institutions and the various wealthiest individuals. And so people who want to be able to access it often can't get it. And so now what is happening is the creation of the SPVs in a way in which it can give you access. Is it the ideal choice? I don't know. You know, I think to be played out, I think there is something to be said for an SPV that's created and it has slices of different private companies that are going to go public in a way in which you can maybe perhaps create a more diversified portfolio or a diversified offering.
And when it comes, you know, to a diversified portfolio, I wonder, you know, how you should approach thinking about including privates. Does it make sense, you know, where you look at a portfolio and you say, okay, I have a private portion and I have a public portion? Or, you know, does it make more sense to be like, I have an equity portion, some of it is private, some of it is public? same goes for fixed income.
Yeah, I think you're asking the right question. I suspect that what you will see in time, I've always believed this, is a convergence of the two where you end up either on one single platform or through technology can connect so you have a holistic view of your ownership, right? Like you see, this is my portfolio. Within it, here's what's public, here's what's private, here's what's in equity, here's what's in fixed income. And how do I create a truly balanced portfolio doing that?
I just in conversation right now with Mitch Caplan, the CEO over at Willow Wealth. I do just want to bring to the attention of our viewers, we are awaiting that pricing on SK Hynix, and it does look like we have it. The shares now being offered at $149 each, roughly in line with what Bloomberg reporters had reported out in the run-up to this. We'll get back to that story in just a second as that continues to cross the wire. And Mitch, I do want to go back to this idea of the transition of private companies into public markets. And the issue of regulation and whether the regulatory environment is going to be supportive, and not just a private into public, but also what you're talking about too, the idea that you do have this private space that may stay private, and the access of individual investors, and whether you think that the regulatory environment here in the U.S. Is it supportive of that now? And if so, will it continue to be?
Yeah, I feel there's a real level of support. I think that ultimately, from a regulatory perspective, they want to see consumers have choice. They want to see consumers have access, right? And so the issue for me, when I made the initial investment in our family office into Willow, it was really because I believed it was creating that level of access that had occurred when we were building E-Trade, right? It was the idea of, could you make available to retail consumers, albeit accredited and qualified purchasers, but that's who we serve, but make available to them options that just didn't exist in the broader market. And so I do think that the regulators see the value in that, and the best way to protect is obviously through education.
And that accredited investor status, I wonder, whether you think that is still the gold standard, that should be the bar, because you think about this push to really open up private markets down the wealth spectrum into retail. It just seems like the tide is shifting a little bit.
I agree, and I think that often when you talk about whether it's a qualified purchaser or accredited investor, what you're really, I think, trying to navigate is, do they have enough wealth to be able to endure a loss, right? Because private markets, there's risk associated with them, just like there is in public markets. And so that doesn't mean that they have the psychographic profiling in a way that they're really sophisticated, right? So you have lots of investors who would qualify as accredited or qualified purchasers, but yet really need to be educated in the space and really be able to use technology in a way to guide them to make better choices.
Well, Mitch, we got to leave it there. Always wonderful to see you. That is Mitch Caplan. He is the CEO of Willow Wealth and the former CEO of E-Trade. Meanwhile, just to reiterate those headlines coming out on SK Hynix, getting some pricing details now, said to price their U.S. share offering at $149 a piece. Bloomberg had reported earlier in the day that is where they were guiding their offering price per ADR, $149 a piece there. We'll continue to follow that story. This is The Close on Bloomberg.
We're bullish, these two subsectors out of those that I cover. So that's specialty retail and department stores. We're at last 12-month lows, below 4-year trading averages. And you take that against what's also a typical seasonal rally into year end. Our stocks are almost always outperformers, really starting in like mid-September-ish onwards. To me, that makes for a very favorable setup, and it's why we're bullish, broadly speaking, on this group.
That was Alex Stratton. She is Equity Research Managing Director over at Morgan Stanley, laying out her bull case for specialty retail and department stores on The Close yesterday. And our next guest's retail outlet business has been surging this summer, with the stock recently hitting an all-time high, helped by experiences and by World Cup tourism. Joining us live in studio, I'm pleased to say, is Stephen Yalof. He is the president and CEO of Tanger. Stephen, great to see you as always.
Thanks for having me back on.
Let's start with the fun stuff, and that is the World Cup, of course, because my understanding is that, you have a lot of exposure when it comes to the different host cities around North America.
That's right. We're in 8 of the 11 host cities in the U.S., and we've seen, incredible traffic in our centers because of that. The last time I was on, we were talking about the story of localization, that more people were moving into the markets where we have shopping centers. Just shift in population. And this summer was the summer of domestic tourism. We were really focused on that U.S. tourists drive to, gas prices were slightly higher, people weren't traveling internationally as much. And now with the international customer coming to the United States, looking for all things Americana, they want to go to Buc-ee's, they want to go to Chick-fil-A, and they want to shop in our outlet shopping centers.
Yeah, it's really funny on social media. I mean, you see those videos, international travelers experiencing the U.S. for the first time. It's been really fun to follow. But I wonder, how you sort of capitalize on that. Are you seeing more, of the brands that you work with putting forward their athletic type apparel, or what do people want when they're traveling for the World Cup?
Well, it's interesting. Adidas is soccer, and they're really owning the moment right now. And fortunately for us, we have Adidas in all of our shopping centers, and it's served as a great draw, a great halo for all of the athletic brands too. So, where, Nike, we're talking about some of the issues that Nike has had in recent months, yet folks are coming in for athletic apparel. They're shopping Nike as well as New Balance. New Balance, a great story. A younger consumer is now gravitating to this older brand that's having a great resurgence, like a number of the apparel and accessory brands that we've seen that same effect.
It's funny. We were talking a little bit earlier about Levi Strauss. They just came out with their earnings, and the CEO was talking about denim luxury, which I don't quite know what that is, but apparently it's helping their earnings. But in all seriousness, it gets to this idea of fashion trends, and I do wonder, with the type of stores that you have and the way that the whole centers are set up here, is it kind of tied into the cyclicality of these trends, or do you try to make them so that they're a little bit more neutral, if you will?
Well, when we're in the landlord business, so when we lease space in our shopping centers, we're doing 5-year, 10-year leases. So, we're betting on brands that we think will have great staying power throughout that entire period of time. And again, retail is a cyclical business, and when you're hot, you're really hot. Levi's is really having a moment right now, and it's amazing. I was watching Dana on the show a little bit earlier, just talking about the product and the fashion, and she's really gone to school on that brand. But we're seeing it in the sales, and we're seeing it in the traffic that not only are they pulling into the center, but the sell-through and the traffic that they get in the store as well.
You were talking about kind of where you locate things and the idea that people are kind of gravitating to these communities. You did a deal, I think, towards the end of May for the town center at Levi's Commons out in Ohio. Yeah. And it's a full price one, right? That's right? And that's like your fourth kind of big full price one that you've done. I am curious about the balance that you're looking for right now in terms of your overall business model for Tanger between the more full price model and the discount model that I think a lot of people normally associate with outlets.
Sure. Yeah. Well, Tanger was founded on the outlet model, and we've been in business for over 45 years. And over the last 5 or 6 years, we've learned that in order to succeed, outlet or full price shopping center, you have to be a lot more things to people. People aren't satisfied with just coming into an outlet center and just shopping for value. They want to be entertained, they want better food, they want great amenities, they want a loyalty program. And those are things that we've brought to the table over the course of the last 4 or 5 years. I think that same muscle that we execute to when we service those outlet shopping centers is highly transferable to that full price open air lifestyle business. So as we continue to sort of add lifestyle components to our outlet shopping centers, we're actually now working in a lot of these in the lifestyle space, and we're growing that business as well.
Well, I want to bring you into sort of a demographics discussion we were having earlier in the show. And, when you're adding those components, I wonder who you have in mind, because, we were talking about CoverGirl, for example, sort of swimming against the tide, focusing more on Gen X, because you think about the Gen Z consumer, it's, a very competitive age group. And I wonder how you're thinking through those different age categories.
That younger consumer is definitely looking for health and wellness products. They're looking for athleisure products. So we like to merchandise our centers towards the cohorts that we're going after from a marketing point of view. I would say, the outlet business, and I've said on the show before, but what's unique to outlet is that we have a marketing team in-house, because most of the brands and outlets don't spend a lot of their marketing dollars marketing their stores. They want to send you their full price arena. So we have to do a lot of that marketing ourselves. And because we've got this great marketing focus in our business, we're able to go out and speak to the customer using our social media channels, using our direct marketing channels, using our digital out-of-home model. And because we have all of that set up, we're able to go after the cohort that we want. But even though we might get them to come into our centers, unless you have the products and the brands for them when they get there, they're not going to come back. So between the tourist customer that we speak to or that local trade that we're speaking to, we're making sure that we're merchandising our centers accordingly for that customer to come and shop us.
All right, really always appreciate it, Stephen. Great stuff there. The president and CEO of Tanger, Stephen Yalof there. As we continue to keep an eye on that breaking news with regards to SK Hynix, we are getting more details here about the pricing of what is the biggest foreign listing in U.S. markets. It did price at about $149 a share based on Bloomberg reporting. We're also learning, Katie, here that the top 25 accounts took about 67% of this sale. Of course, these are ADRs 10 to 1.
Absolutely. Yeah, really interesting. Also reading through these terms, it looks like their U.S. offering approached $200 billion of demand. So really interesting to parse through this. Bloomberg had reported earlier in the day that it was about 7 times oversubscribed, which really speaks to the appetite for exposure among U.S. investors. Yeah, and we should point out we are going to have an interview right here on Bloomberg tomorrow with the chair of SK Hynix, so you don't want to miss that. The close isn't over yet either. We'll be back in a moment right after this commercial break. This is Bloomberg. Delta set to report results tomorrow, kicking off earnings season for the U.S. airlines. Michael Linenberg, he is research analyst over at Deutsche Bank. He joins us now on what to expect. And Michael, I mean, you think about the grouping of U.S. airlines, the consensus out there is that Delta is maybe more insulated than some of its peers, or stands to be at least the least impacted by fuel costs versus some of its competitors. Is that your analysis as well?
Yeah, no, I think, Katie, and by the way, thanks. Good afternoon. I think that is a correct assessment, but I would also include other full service carriers in that bucket. As you know, the revenue segments right now that are performing best are premium and corporate, and those are the segments that Delta and United and American lean into. It's also important to note that Delta does own a refinery, and so that has historically, benefited them during periods of volatile fuel prices.
Yeah, absolutely. Have to mention that's a big benefit, especially over the past few months that we've been seeing here. I mean, you mentioned premium, and that's certainly an area where Delta is strong, but overall, I mean, you think about what we're seeing when it comes to sticky inflation. We've seen ticket prices really rise across the board here. And, I wonder how much sort of pricing power a Delta has left, especially compared to some of the peers that you mentioned.
So, what I think across the board, actually, we're seeing stickiness at all levels. And again, at the sort of upper revenue segments or the higher yield passengers, they tend to be less price sensitive. And so for sure, you will see maybe a higher level of stickiness, if I can refer to it as that. But the entire fare structure has actually moved up. We've had 8 fare increases since the start of hostilities back in late February. And I would say that, the demise of Spirit, I mean, that has been really a seminal moment in the industry, because that was at least 100, 150 planes that were flying. And in many cases, those airplanes were not generating positive returns. In fact, if we look at which markets had some of the lowest fares, they were markets where Spirit was basically pricing to just generate enough cash to stay in business. And so with Spirit out of the equation, the whole fare structure has moved up. But you're absolutely right that it is at the higher end where it is the most sticky, but we are seeing some benefit on the bottom end. And as a result, I think we're going to see this rising tide lift all ships, including maybe what we would call as the leaky ships, right? The airlines that have historically not generated profits.
Yeah. Well, that's what I'm curious about, Michael. I mean, you bring up Spirit, and there was obviously a little bit of concern, at least raised by the company and some other folks, about whether they should have been allowed to move forward with some M&A activity that maybe could have potentially changed the ship. But when you look at some of those leaky ships, I don't know if you're referring specifically to JetBlue and some of the other ones, but do we start to look at those names and think, okay, let's pay attention to the potential for M&A activity?
Yeah, no, I think if you have companies that are still losing money, and in some markets there's still too much supply, depending on who you're talking to, there is room for additional, let's call it rationalization. And so that could be a merger, but it could also be a partnership. It could be an alliance. And so, Romaine, you're probably well aware of the fact that not that long ago, United and JetBlue started a partnership. And what we've seen over time, since that's now been up and running, about a year, we have seen them, roll in additional phases. And so that partnership, has expanded. And we've seen the recent merger closed between Sun Country and Allegiant. So there are changes and they are structural, but ultimately we got to get to a point where, companies have to make money. And the fact that you still have some carriers that have not generated a profit since COVID, that is just absolutely not sustainable. That will have to be addressed. And the market will address that in some way, shape, or form.
I am curious in terms of how the airlines market themselves to the consumer. So just getting beside what the market wants. What is the differentiation? I mean, because it felt for a while you had these low-cost carriers that had staked a claim to that. You saw what happened to Spirit. It seems like Southwest is kind of abandoning its sort of simple low-cost model. And I don't know. It seems like a lot of the airlines are all kind of clustering into the same space. Is there a differentiation, or does it matter?
We had recently put out a report where we talked about the end of the, low-cost carrier. And I think a lot of it has to do with the fact that we've had some pretty significant inflation in the U.S. over the last 5 years. Mm-hmm. And if you think about it, these low-cost carriers, what was their business? What was their MO? They were in the business of demand stimulation. But overnight, if your major costs go up by 30, 40%, right. Guess what? You cannot stimulate demand. You cannot fill up those airplanes. Yeah. What do? You lean into premium.
Yeah. All right, Michael. I'm sorry, Michael, to cut you off there. We're up against the clock. Always appreciate it. We'll catch up with you in a few days again, I'm sure. Michael Linenberg, research analyst over at Deutsche Bank, as we wrap up our show here on The Close. Katie and I will be back tomorrow for all your political coverage. Stick around. Balance of Power is up next.